Welcome back to the channel, Crypto Trend Trader, with our Friday morning market wrap up. And of course, as always, I don't need to tell you, but this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so obviously the big news is the Jackson Hole Symposium going on this week. And we had a speech from Jay Powell, the head of the Federal Reserve, this morning. And he definitely kept it short, which normally, he goes on his little tangents. And, typically when he does a presser, you'll see, he will answer some questions, etc. We saw a couple of the various Fed chairs interviewed over the last couple of days, and I thought they laid it out pretty clear. They essentially said, we need to see sustained data. We need to see a trend of inflation coming down. Right now, the absolute most important thing, and we have discussed it over and over and over again, the only thing that matters to the Fed, therefore, the most important thing in the entire market right now is inflation. 100% inflation. That's the only thing that matters right now. And while everyone got excited over the 9.1 coming down to 8.5, I mean, the only reason that's even good is, the example where, you basically get a really, really bad number, and then it's followed by a really, really bad number, but it's not quite as bad. So everybody gets excited. But that's not how the world works, and that's not how markets work. So obviously it was an unsustainable move. But the importance of trapping people in positions or in markets is you obviously need to move so far to the upside that people FOMO in. And the best part or worst part, depending on if you're the one FOMOing or dumping on someone's face, is obviously the point at which you get them to FOMO in. So we're going to talk about it with the traditional markets. Obviously, crypto is currently melting down as we speak, as expected. We are getting ready to take out the lows. Obviously, the low of the trend is right around like that. It's just below 20,000 essentially. And we're getting very close to taking out the lows at this point in time. Now, there are still some lower lows from this point, but we have broken down from the channel that we have been operating in this entire time. We basically had an ascending channel, and we're breaking down from that channel undeniably. Arguably, depending how you drew it, we already had broken down. So we'll discuss that. We're going to obviously go into crypto. We did a deep dive in anticipation. You guys know our targets to the downside, obviously very clearly in a bear market still. Obviously, crypto has pathetically underperformed in comparison to even the most trashiest of stocks in the stock market. But before we get to all that, let's take a look at our typical rundown. So we're seeing some strange moves in the 10-year. Of course, everyone is calling it Federal Reserve manipulation, saying that they are buying bonds and they're the ones creating this fake demand in the bond market that's propping it up, basically. And that is what's causing the pressure of the yields. Is that true? I mean, who knows? It's complete speculation. I do want to dispel a myth really quick, and I'm going to do a deep dive on this. But everyone is saying that the Fed has promised that they were going to sell, bonds and treasuries and mortgage-backed securities. And one, the Federal Reserve doesn't make promises. They do whatever the fuck they want. So that's already stupid. So anyone that says the Federal Reserve promised they were going to sell and they're not doing it, and so they're liars and they're mean. Okay, sure. I mean, one, the Federal Reserve doesn't owe anyone anything. Two, they are a private entity. It's not like you can vote them out of office. They're appointed. Three, who cares? They could literally promise anything they want and then do whatever they want. I mean, so it's like a moot point. And then on top of that, obviously, anyone that really knows what is going on knows that they're not actually selling anything. Now, they have said they were going to let assets run off their balance sheet. They were going to decrease the size of their balance sheet. That is not by selling things. It is by asset maturity. So think about it like this. If you were to basically buy a bunch of treasuries with, say, like short-term duration, like 3-month treasuries or something, if you're buying them consistently throughout a month or throughout, a quarter or throughout a year, you're going to consistently see they have different expirations. And typically what the Fed does is they buy on the 15th and the, end or beginning of the month, right around the end of the month, etc. So, essentially like 2-week periods, they typically make these purchases. So we would expect to see the runoff in 2-week periods with like different duration increments, short term, like 3 months or, 1 year or, whatever. So they don't just immediately say, okay, we promised that we were going to sell 60 billion. So here we go. That's not what happened. That's not what they even said. They said they're going to set target rates of like 60, whatever, and 95 billion by the end of September. They would expect to have all of the like ramp up for the QT taking place. So even if that's the case, there's then going to be a lag of 2 weeks, a month, 3 months in cases. We don't know exactly when each and every single asset on the Treasury or on the Federal Reserve's balance sheet matures. So there's going to be times when less than, the 95 billion matures. And there's going to be times when more than the 95 billion matures. So if less matures, possibly in the future, which the Fed has already said, they will consider, selling instead of just balance sheet runoff. And Mester actually yesterday on an interview said exactly that. And then also there's going to be times when, maybe it's a big month for maturities and we see, 150 billion runoff. So then the Fed actually will purchase back some because that's over what their target is. Potentially, maybe they just let it be more. So it's just a weird situation right now because with the internet and all of these, fake gurus and financial influencers and all this stuff, everybody's pretending like they know what's going on, but really it's just a bunch of bad people. Like, and I don't mean bad, like, oh, they're bad. It's like bad information. A bunch of people are playing telephone, and the person who's feeding them all their information to begin with doesn't have any fucking idea what they're talking about. So you just end up with a bunch of dumbass people repeating dumbass shit that doesn't make sense and is not true. And then there's like a couple voices out there that actually know what's going on, but they don't have the big megaphones or microphones. So, it gets like kind of pushed to the wayside. So, we'll take a deep dive into that. I'm going to look at it, explain some stuff. I will show the Federal Reserve chart and the Fed's balance sheet and all that stuff. But again, just careful who you're listening to because it's just a bunch of brain dead people repeating the same thing. It's just like technical analysis. I call it out all the time. 99% of technical analysis you see is either hindsight TA or someone else stealing someone else's technical analysis and then pretending like it's their own. So anyway, so we got a lot to talk about today. We're going to go ahead and jump in and take a look. So here is the TNX chart. Obviously, we have looked at this quite a bit lately. Obviously, we have our confirmed breakout below. In this case, I have this, parabolic curved support line here in blue, and then the parabolic, red resistance line here in pink. And we basically started to break out and backtest the 200 exponential and simple. And then with the most recent move, we have broke out and found support at this level. And now we're just chopping through a serious resistance. We have resistance from the peak right here in 2013. We have resistance from the peak right here in 2018. We obviously had a massive parabolic move to the upside. So it's not crazy to think as we bang our head on the multi-month, 200 exponential and simple, that it's going to take some time to get through here. And also, while we have already confirmed with a wick a higher high on the Treasury yields, and I'm essentially using this as a proxy for the Fed funds rate or just, Treasury yields in general or mortgage rates or whatever else, because they're all essentially based on the same core number, the underlying number, which is essentially the Fed funds effective rate. So we have a technical breakout already on TNX and many of the other duration charts. But we don't still technically have a breakout on the Fed funds rate until the next meeting and rate hike. And if we get any amount of rate hike whatsoever, 25 basis points or more, which obviously it's either 25 or more or nothing. And I don't expect nothing. I expect probably 75 most likely. So that being said, once that happens, we will then have a confirmed technical breakout on the Fed funds rate. And then all of these other breakouts that have already taken place will essentially be verified. So that's what the market is waiting for. The market is currently consolidating at the highs waiting for that to happen before it can then start its next leg higher. And we obviously know the next leg higher is the previous peak from 2007 right here, and that's around 5%. And we already saw, I keep saying, just keep your ears open because you're going to start hearing 5%, 5%, 5%. Keep listening. You will hear 5%. Okay, it hasn't happened yet. I haven't heard anyone say 5% yet, but it will happen. Okay, and you'll hear people talking about, oh, we're already neutral, so the Fed pivoted, blah, 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 blah. It's all bullshit. It's all wrong, obviously. I've shown in many videos why it's wrong and why people are just dumb as hell, and the difference between analysis and hope-analysis, okay? If you're just hoping and praying for something to happen, and that's like what you're going by, you will lose all your money. It's just a matter of time. I promise you that. If you're not going to trust the technicals when you see them, you'll lose all your money. Same fundamentals. So that being said, you're going to start hearing 5%. People are going to start saying 5%. You're going to hear it first from a couple of people here and there, just to kind of whisper, oh, I think maybe 5%, possibly as high as 5%. We could see rates of 5%. And then after a while, everyone will be saying 5%, and then we will be at 5% before long. That is the next level for the technical breakout. And now I want to do something different here. I want to turn off log scale. Obviously, I use log scale 95% of the time, 99% of the time. And the importance of that is the difference between dollars and percentages, okay? So like if you're looking at an asset that's denominated in dollars, like say a Bitcoin chart, it's going to look skewed if you're not in log scale. And the reason is because it's in dollars. So the moves in the beginning when Bitcoin is between a penny and $10, that's a $10 range. So on the chart, on the chart, no, that's not the right word. On the chart, the $0 to $10 range is going to show up as just a flat line. And because, the top of the range for Bitcoin is 70,000. So if every increment was denominated in $10, the chart would literally, be completely flat forever. And then as it gets into the hundreds, the thousands, the 10,000s, it gets bigger and bigger. Now, when you turn on the log scale, it denominates it in percentage moves. So it's basically going to look much more realistic as to what's actually taking place for like an asymmetric asset. So that is why I use log scale all the time. Now, if you have an asset that never moves and never does anything, and it's, the entire trading range is from $10 to $20 or something like that, sure, that's fine. You can use whatever you want for that. And, a lot of people traditionally in the stock market do not use log scale. I use log scale because it makes way more sense, especially with the increased volatility and massive like melt up and moves we have seen recently, in traditional markets, which are obviously not what you normally would see over an extended period of time. So that being said, when we turn off the log scale and then we turn on our drawing tools again, we have this channel here in green. And you'll see we still have our pink resistance and our blue support as well. But we're just going to focus on this green channel. And I mean, this is literally the peak of the channel from 87, the trough of the channel from 86. And we have literally operated inside of this channel absolutely perfectly, literally bouncing from top to bottom, sometimes stopping along the middle way, etc. But literally the entire time, this entire almost 40-year period. So we didn't technically break out right here. I mean, it was close with that 2018. But here, this is undeniably a technical breakout. And we can see this massive candle that we got in March, this gigantic green candle, literally poked its head out the top and then closed exactly at that line. So, obviously bots, algorithms, traders, market makers, whales, all looking at the exact same thing we are. Maybe they're not looking at log scale. Maybe they are. Maybe they're looking at both. Maybe they're only looking at, our regular chart. But regardless, there's no denying that people are looking at this. So, important people, not like, Karen from the school board who's telling you to buy Shiba Inu coin. I'm talking about actual people that matter. Okay. So that being said, when we break out from this level, I mean, we immediately get a massive pump after that. And at that point in time, we compromise the 200 exponential and simple moving average as well. So now we have broken out from the downtrend, confirmed. We are back on top of the 200 exponential and simple, confirmed for the first time, literally in existence. I mean, the last time we opened and closed above that level was back here before we went into the bear market in 1985. So in December of 1985, we started this process. And then here, when we closed outside that level in April of 2022, we started the reversal. And then what happened? We exploded to the upside. Everyone said, oh, that's a shooting star candle. It's topped. Rates are going down again. The pivot will take place. Rates are going back towards zero. They will trend lower. We will resume the downward trend. Bonds to the moon, assets to the moon, rates to zero. But what they don't realize is something changed. When we came back down and back tested the 200 simple right here and then started moving back up, we now have the 200 exponential in a bull trend, bull slope. 200 simple is almost flat and very close as well. And this is what the beginning of a trend looks like. And I talk about this all the time. I talk about this chart here all the time. Because to a normal person, when they see this chart, they say, oh, this is a terrible chart. This is horrible, right? Because we're just in a bear market for 30 something years. That's terrible. Why would anyone ever pay attention to this? Exactly. Exactly. Okay. You guys know I'm obviously conservative investor, speculator, trader, whatever you want to call it. You know, it's no secret that this is the chart. I always talk about the best chart. Okay. Because when something does this for a really long time, especially like 30 or 40 years, everyone gets recency bias. So they start to think, I mean, they may not even look back at this old chart like this, but they start to think, oh, okay, every time we get to this level, every time we come up here, we get rejected and we go lower. So now we're getting ready to get rejected and go lower. But that's what's so beautiful about it is everyone loses all of their money in two places in the market. And we know what that place is. It's the pivot. The pivot between a bull market and a bear market, everyone loses all their money. The pivot between a bear market and a bull market, everyone loses all their money. Why is that? Because of recency bias. They get so used to shorting in a downtrend that when the trend flips to bullish, their brain can't function correctly. So they're unable to flip into a bullish setting. And without a rules-based system, without quant analysis, they're unable to make that pivot. And by the time they do, it's too late. They've gotten wrecked. And that's what we're looking at right now. And it's the same way in a bull trend. When a trend is going parabolic and everyone's used to, you know, things going parabolic and the melt up has occurred for years or decades or whatever, they're getting more risky and levering up and, you know, more and more money going in and the gains are crazy and everything just goes up and all, you can't be wrong. And then they don't realize when the trend has switched. We saw it with Bitcoin and it immediately dropped from 70,000 to 30,000 and people got wrecked. And it's like, well, we're still up how many 1,000% from this, that, and but that's not, it doesn't work like that. And it's the same way with Cathie Wood. That's why I always give her, you know, dumbass so much hell, is because it's the same thing. If her fund is, you know, $100 million when it's worth whatever, and then it goes 10x, but all the money flows in at the top, and now that $100 million fund is worth 40 billion, and then it gets cut in half. Well, sure, you created 2 billion in wealth. Congratulations. That's amazing. I mean, most people will never achieve that in their life and can't even grasp the amount of wealth that was created by Cathie Wood. But also the amount of destruction that took place when it went from 40 billion to 20 billion. If you create 2 billion or 5 billion in wealth and then you destroy 20 or 30 billion in wealth, did you net create wealth or did you net destroy wealth? Cathie Wood is one of the biggest net destroyers of wealth in existence. I mean, she has literally, what she has done, most people will never be able to do. And if you adjust it for inflation going into the future, there's a good possibility that no woman that ever walks on the face of the earth will be able to destroy as much wealth as she has. I mean, it's obviously an amazing feat that deserves some kind of medal or, you know, it's an amazing achievement, you know, achievement unlocked, over 9,000, you know, horrible wealth destruction. So obviously my point being, the same way that Cathie Wood was unable to pivot at the top of a bullish melt up, people are unable to pivot at the bottom of this chart right here. And what this chart tells us, obviously, is the cost of money. And we know that all markets depend on the cost of money. Rampant speculation depends on the cost of money. Part of the entire system worldwide is based on the idea that we just pull forward demand from the future. That's all we've been doing for decades. That's essentially the idea of credit. Okay, I don't have enough money to buy the thing I want, so I'm going to borrow money now, and then I'll buy the thing I want now, and then I'll work my ass off in the future to pay down that debt. And that's essentially, you know, what credit is. And so as long as we're in an environment with expanding credit, that's okay, because we can keep pulling forward more and more demand, and people can keep racking up bills. If you, let's say, borrow $1,000, okay, and then you have 1 year to pay it off, you now have to figure out, okay, how am I going to get this extra $1,000 to pay down that plus all of the other things that I normally would have to pay? So you have borrowed demand from the future. You have pulled forward that demand. And then later, you're going to have to pay the price for it. You got to pay it back. So maybe you take that money, you borrow it, you put it in your education, and then over a long term, you benefit from it. Maybe you take that money and you speculate on Bitcoin and then it doubles and then you pay it back with that. Maybe, there's so many examples of how, maybe you just buy beers with it and you drink them. And then one day you're like, oh man, I wish I still had those beers left. Now I just have this debt and no beers. So you pull forward all this demand. And that's what's been happening for literally decades, arguably, centuries. Okay. I mean, you hear about in the 1920s, 1930s, you hear about the same situation, massive amounts of leverage and over leverage in the system and all this stuff. So again, this has been going on for so many years that people don't think it could ever stop. But this chart right now is beginning to flip, the trend flip. Now we have obviously stages that I use to identify when this trend is slipping. You guys know short term, obviously, we look for bullish divergence. We look for a leaving of the bearish control zone, a hard buy signal, Stokes angled powerfully to the upside, bullish control zone. We see all these different steps along the way. And the same with the moving averages. First, we cross the 8 and 21 to the upside. Then we cross over the 200 exponential and simple. Then the 200 exponential and simple, start to move to the upside and flip blue when they have a positive slope. Same with the TDMACD. Multiple green histograms. We hit the zero line. We cross the slope line. The slope turns blue. All of these things are just little check boxes. And we have, essentially just with these 3 indicators right here, we have like 10 check boxes. And as we check each one of these boxes, we get more and more bullish, or vice versa in a downtrend. We get more and more bearish as we start checking these boxes. And that is not using your emotions, not using your feelings. That's fine. You can use your emotions. You can get a bad gut feeling and say, you know what? I'm going to override my system. But in order to override a system, you have to first create a system, a rules-based system, quant analysis, however you want to do it. It's the same thing that's taught in jiu-jitsu. Before you can break the rules in jiu-jitsu, you have to learn the rules. You have to learn what you should and shouldn't do. And then later on, you can use your own experience or your own methods or whatever. You can break those rules, bend those rules, and then use them to your advantage. But first, you need to know the rules. So that's why it's so important. That's why our strategy is so damn important. And that's just for all the technical analysis portion of it. And then on top of all of that, then we have our, probability of success, our risk reward, our position sizing, all of those other things as well. So then when we combine all of that together, we now have a legitimate system that you can write out on a piece of paper. I don't do it specifically, but I share it with you guys so you all have access to it. Understand that many people sell these things for ridiculously large amounts of money or will never reveal it to anyone. I mean, how many times do you see, big traders or firms or hedge funds or whatever, family offices, and they don't share their strategies. They're not going to tell you the details of your, could you just do it yourself? So what are you paying them for? What are you paying them for? It doesn't benefit me though. I'm not selling my strategy. It doesn't benefit me to just hide it away and keep it. I would rather benefit, the common man and create a community of like-minded individuals and create wealth, unlike, certain, queens, the queen of the meme stocks, Kathy the loser would. So anyway, my point being, this is the chart we look for. This right here is the chart we look for. It's the flip of a long-term trend, in this case 30-something years. So we're about to flip this trend bullish for the first time in 30-something years. This is literally, this is it. This is the money fucking maker, okay? People will look back at this chart in 20 years or 50 years or 100 years and say, holy fuck, what a time to be alive. The amount of wealth that was created, if you see this trend and are able to capitalize on it, is unbelievable. The same way that you would say the amount of wealth that was destroyed when we basically confirm it to the bear market and then go into this 30+ year downtrend, and stock markets go parabolic and cryptocurrencies go, all these things. So this right here, we're literally, we've 4 months broken out over here. We're very, very close to, I don't even know how to put this simply, but the amount of wealth that is about to be generated by the people that recognize this early is going to be life-changing. And I'm not talking about just for you or your spouse or your kids. I'm talking about generational wealth is going to be created and destroyed. And, a lot of that wealth that's destroyed is going to come from the top. And a lot of the wealth that's created is going to come from people like us. So get ready. Now, it doesn't have to happen. It could fail. But we're going to know very soon. And with the Fed funds rate breaks out on a technical level beyond this previous peak, at the next meeting when they hike rates next month, that's going to be the confirmation to the markets. Like, hey, there's no doubt in anyone's mind yet. It's absolutely official. We have broken out. And now everything that has been true for this last 35 years is now going to be opposite. Okay. So what has been going on in the markets for the last 35 years? We've talked about it nonstop. We're going to skip over to the Dow Jones real quick. I'm going to go over to the monthly real quick. Let's look at that. This goes from 1897 up to, current day. And we're looking at that period from, basically like 1970s, 1980s. Actually, let me go back here and just point out the area that we're paying attention to. So this is the beginning of the chart in 63, and this is inflation out of control until 81. So from 63 to 81, there's massive amount of inflation, and Fed's funds rate is going through the roof. Okay. And then after that, then we go into the meltdown, or in this case, the melt up. So the same way, what did I say? 60 to 81, 63 to 81. So let's look at what the stock market was doing during that time period. Prior to that, obviously, it's just going parabolic. We obviously have the meltdown, the crash of the Great Depression, all that good stuff, the 1920s roaring, etc. So this is that period in time, okay, when inflation was out of control. This right here. So when inflation was out of control and rates were rising, what did the stock market do? From the 1960s until, basically this is 1982, we finally confirmed the technical breakout at the end of 1982 into 1983. So the stock market literally just went sideways this entire time. That is what was taking place while this was taking place. Okay? And then after that, once inflation starts coming down, once the Fed funds rate goes down, we eventually enter into the bear market. We don't know and confirm until 89, but obviously we can see very clearly a lower high and it's starting to come down. And then that is still present day. So during that period of time, as this is melting down, we can go back and look at what's been happening in the stock market and see potentially, hey, what might we expect based on, actual statistics, data. So again, this is that same period. And then what happened after that till present day? This is the Dow Jones up 3,268%. So one could argue that some wealth was created along the way. So this is when rates were rising and there was inflation. This is the 30+ year period when rates were melting down. And again, same thing. So what is likely to happen if we go into a similar situation like this, where we confirm a technical breakout and we start to get a measure move to the upside? Let's say we only go up to 382 of the macro. Let's say we go to the 0.5. Let's say we go to the golden retrace. Maybe we see, inflation at 8%. Maybe we see it at 10%. Possibly we see it at 6%. We know arguably the next resistance is at 5.2%. So any of those things are valid, but are we more likely to get a situation like this as this is going up here and we're confirming a technical breakout? Obviously, yes. And where is that going to take us to? Again, we don't know. Let's just say it takes us to the 618. And let's just say it lasts for, 10 years or 15 years or 5 years or 20 years. I mean, we don't know. So let's say, 2027, 2035. We don't know how long it's going to take. We don't know how high it's going to go, but we have some pretty clear areas we could pay attention to. So if we see another period like this, I mean, it would make sense for a rational human being with a brain who knows how to do technical analysis. And now, look, no one on earth has done what I'm doing right now, obviously, because everybody else just copies what everybody else does. Nobody talks about this, what's likely to happen, the correlation, because everybody's looking at things in hindsight. No one is looking out into the future, making rational, potential predictions as to what to expect, because everybody just copies the same shit. So if the same talking heads just keep saying the same thing for 30 or 40 or 50 years or whatever, nobody can think with their brains anymore. Everyone's melted down and they're just mush. What would we expect to happen? Let's say best case scenario, we get a situation like this. The stock market just goes sideways. Okay. How low does it go? Well, I mean, we can extrapolate some of the moves down here. We can look at what has potentially happened in these markets. Okay, from the peak to the trough, what did we see? About a 42% downside. So let's go over here and say, okay, so what if we get a similar type situation, roughly 10 or 20 or 30 years, maybe it's only 5 years. We don't know how long it's going to go sideways for, but let's just say we get a roughly 40% move from the all-time high down. Where's that going to take us to? Roughly somewhere around here. And what was that? That was the 2020 lows. And this is on the Dow Jones, which is one of the stronger, charts, obviously. The strongest 30 companies in the U.S. economy. So let's just say we go sideways here for a couple years, 5 years, 10 years, whatever. So, we'll put it at, 2022 now. So let's just put it out at to 2032. So roughly we just oscillate in this range for the next 10 years. Bouncing around down 40, up 80, down 40, up, that's what we should expect based on historical data. Now, this period is not going to be the exact same as this period, obviously, but the correlation is what matters. So this is probably the most important, fundamental or technical argument that you should understand, is that the potential for a scenario like this is there and likely. It's very, very likely. Now, could it get much nastier? Could we see ridiculous pullbacks and much deeper retracements and breaking down of technical levels? 100%. And we know, obviously, we operated inside of these various ranges for literally decades at a time. We've been inside of, this peak right here and this trough right here and this ascending channel on log scale. We've been inside that range since 1929. So, 90 years almost inside this range. So the likelihood of breaking out of this range is almost zero. So, if we're at the top of the range right now, and, we basically poked our head out of it, now we broke back inside of it, and we're holding support at the pre-COVID levels, and likely we're going to come down somewhere around this, and likely we're going to go, sideways to down for a few years. There's a strong argument that a buying opportunity would be at 21,375 when we intersect with the heart line. There's a strong argument that we could just chop through here and continue going sideways so long that eventually we actually touch the bottom of the channel without going down. Maybe we go sideways until 2044. And by the time we do, we hit the bottom of the channel and then we start going up again. Maybe we go, substantially lower in substantially shorter amount of time. And we actually see a disgusting dump that takes us back to, 2008 levels. Is that crazy? Or what about a back test of 2000? The same way that we back tested after this parabolic move right here, and we back tested the Rona high right here. It's not crazy to think that if this breaks down and melts down, that we could back test 2008 or 2000. So are these valid areas to pay attention to? Of course. Does it have to get there? No. Could it take 20 years? Could it take, 10 years? Could it take 5 years? Does it have to go this low or that low? We don't know any of that stuff for sure, but it's at least worth paying attention to, that this is the likely scenario that we will see play out. Now, could things change? 100%. Could we go back into a straight up melt up? 100%. There's countless things that can happen, black swan events, things that we don't expect, things that there's no way we could have anticipated for, whatever. But right now, as a rational investor based on technical analysis and also fundamentals as well, there's zero argument, in my opinion, for anything but what we have just discussed in the stream. And again, you're not going to find this anywhere else because there's no such thing as independent thought on planet Earth anymore. Okay? We are a dying breed. We are a dying breed. We use a rules-based system and we look at, technical moves and what has happened in the past to extrapolate forward into the future, not with certainty, but looking for probability of success and a tradable edge. And that's what it all comes down to. So is this going to end up being a short-term head and shoulders, and this is the top, and then we're going to break down from here, and rates are going to go lower? Maybe. Maybe it is. It's possible. No. Did we already bottom, and we broke out, and now we're just cooling back off before the remainder of the measure move, and then we're going to go higher from here? Probably. So how do we decide? We always talk about how you can bet on direction, up, down, or sideways, but it's much harder if you start betting on time, which is why options expire 95% worthless. Because you could be right about your target to the upside, you could be right about your target to the downside, but you're probably going to be wrong about your time. And if you're right about your time, you're going to be wrong about your target. And we know that because statistically, 95% of options expire worthless, or something close to that. So why do they all expire worthless? Well, because that time factor makes technical analysis extremely difficult. And then when you extrapolate on top of that, people using, manipulating the markets or whatever, market makers or, people moving the market towards those expirations to make sure that they expire worthless. The same people with all of the money, the whales, are the same people that are selling these options typically. And they're the same people that are going to calculate how do they make more money, by letting the options expire worthless, or by being the owner of those options and then, letting them expire in the money, et cetera, et cetera. And then you can exercise them. You guys get all that, obviously. So sure, could we see yields come back down? Sure. But what do we have right now? We have another one of those hourglasses with the sand falling out of it. We're at the end of August now. We have a couple days left in August. And at the end of August, we then have, a couple weeks before our next Fed meeting. And then at that point in time, we would expect either 75 or maybe 50 or maybe 100 basis point hike, et cetera. Regardless, if we get over that, 25 basis points, we know we have a technical breakout on the Fed funds rate, which confirms that this chart that we're looking at and the breakout essentially is done. And then we're headed up to 5% or 7% or, all the different targets we just laid out. So again, you're not going to find this anywhere else. I mean, and if you do, by all means, point me in the right direction. I would absolutely love for anyone to share with me someone else that's pointing out these key factors, because you know what? It's heavy is the burden, okay, to do all this on your own. So if there's somebody out there that's doing it, I would absolutely love. It's great to bounce ideas off somebody else, to see someone else that's actually doing functional technical analysis. And I'm not trying to build myself up and sound amazing. Okay, sure, I'm arrogant. Sure, I am narcissistic at times. Okay, that's fine. It's true. I give it to you. Touche. But, it is what it is. It's not unwarranted. Let's be real here. So just keep in mind what is happening right now, and that we are literally seeing a generational shift in what is taking place right now. And it's not unrealistic to think that we could go into a sideways to down market for 10 years and see record trillions of dollars of wealth destruction in the bond market, in the stock market, in cryptos. It's not crazy to think that we're going to see countries in absolute chaos, or it's not crazy to think that we're going to see currencies fall off the face of the earth or go to zero, or hyperinflation, or sustained periods of volatility where we see massive inflation, then massive deflation, then massive inflation. There's going to be massive swings, because I promise you, in real time, if you were alive and, knew anything or cared at all about the markets, I promise you in real time that when this stuff is going on right here, this is insane to live through this. 1980s, this is insane. To go from 10-year yields to 13.6, back down to 9.5, all the way up to, 15, and then straight back down to 10, and then back up to 14. These are 40 and 50% moves in the yields in what amounts to, these are monthly candles. So we're talking about in a year, a 40% difference in the Fed funds rate. Similar to what we saw, with rates like at this point in time, but on a much, much smaller scale. Because instead of looking at, 4 and 5% moves in a quick period of time, well, honestly, that is what we're looking at. It could get crazy if this decides to go parabolic. So all the people are doom and glooming and calling for the end of everything and all, oh, you better, have your lead and your food and your water and your security and blah, 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 blah. Sure, things are going to get crazy, and it's never bad to be prepared. But rather than being some doomsday prepper, let's figure out how we're going to take advantage of this, how we're going to create generational wealth, how we're going to secure the futures of our loved ones. And we're not going to do that by hunkering down in a bunker, with a Glock under our pillow and a bunch of, spam. Get the fuck out of here. If the world is going to end, it's going to end, okay? If it's going to go into pure chaos, it's going to go into pure chaos. Sure, we can go ahead and prepare a little bit for this, that, and the other. But let's be real, okay? Lindy effect tells us that the longer something has been going on for, the longer it's likely to go on for. So calling for the end of the dollar as U.S. reserve currency, or, some new global currency, or, the destruction of the United States, or the destruction of, one of these other empires. China is going to break down and go to nothing, and Russia is going to break down and go. It's insane talk. Now, is it possible some of these things happen? Sure, but then it's a black swan event. You can't see this stuff coming. And if you can, everybody else sees it coming too. So that being said, what are we looking at here? Well, I think I gave a pretty clear breakdown as to what to expect. And then we know the parallels between this and the dollar chart, the DXY, give us a much better, overview on what's going on. So we can get into our regular technical analysis here in a moment, but I just want to reiterate what's happening here on the DXY chart as well. Because again, everyone is saying the DXY is topped. It's a blow off top. This is it. It's over because of this candle right here. The same way on the treasuries yields, the 10-year, that they said, oh, that's a shooting star. That's a topping candle. Look at that rejection. Does it look like it's getting rejected right now? Does it look like a top right now? Are you going to be the guy who picks the top by a candle